Warren Buffett is renowned for his insightful observations on investing and human nature. Among his most famous quotes is one that has sparked widespread discussion and interpretation. Many see it as a clever commentary on the pitfalls others encounter, using it as a lens to examine the mistakes made by those around us. Yet, beneath its surface lies a deeper question. Does this quote truly offer a window into others' failures, or does it serve as a mirror reflecting our own tendencies and choices? In this section, we explore the central enigma of Buffett's words and consider what they reveal about the way we perceive success and failure. At first glance, the quote seems to highlight how market downturns reveal the weaknesses of certain companies and expose fraudulent schemes. When the economy falters, businesses that were poorly managed or built on unsustainable models often collapse, making their failures visible to everyone. This interpretation suggests that the lesson is about observing others, witnessing which organizations falter when conditions become challenging. It reinforces the notion that the risks and mistakes belong to those who are caught unprepared. Many people take comfort in this perspective, believing that the warning applies to someone else, not themselves. This surface-level understanding can lead to a sense of detachment, as if the consequences are only relevant to those who were already vulnerable. Consider the possibility that this quote, often repeated among investors, might not be as reassuring as it seems. What if, instead of offering wisdom, it subtly encourages complacency and overconfidence? By accepting its message without scrutiny, investors could be led to underestimate risks or overlook warning signs in the market. This raises an important question. Could the quote be a dangerous intellectual trap, fostering a false sense of security? Exploring this idea challenges us to think critically about the advice we follow and the potential consequences of relying too heavily on familiar sayings. In this video, we will follow a structured investigative approach designed to uncover the layers behind a widely held belief. Our journey unfolds in 3 distinct loops. First, we will expose the myth that has shaped popular perceptions. Next, we delve into Warren Buffett's actual definitions, clarifying what he truly means. Finally, we reveal the real trap that often goes unnoticed. By navigating these loops, we aim to provide a deeper, more accurate understanding of the subject at hand. As we look back on the dramatic downturns that have shaken industries, it's striking to consider which company collapses left the biggest impression. Some failures seemed inevitable, while others caught even seasoned analysts off guard. Take a moment to reflect on which corporate downfall surprised you the most. Was it a household name you never expected to falter? Or a rising star that vanished overnight? These stories remind us how quickly fortunes can change in the business world. Each collapse carries lessons and insights worth pondering as we navigate an ever-evolving economic landscape. The concept of schadenfreude refers to the pleasure derived from witnessing another person's misfortune. Often people use certain quotes or ideas as a way to feel superior, highlighting the failures of others rather than reflecting on their own actions. This mindset is passive, as it encourages individuals to observe and judge from a distance, rather than engage or support. Over time, such an attitude can become dangerous, fostering division and discouraging empathy. By focusing on others' shortcomings, we risk neglecting our own growth and responsibility. It's important to recognize this tendency and strive for a more constructive approach, one that values understanding over judgment. This widely accepted interpretation often leads investors to develop a sense of arrogance and complacency. When individuals believe they fully understand market dynamics, they may become overconfident in their decisions and ignore potential risks. Such attitudes can result in overlooking personal vulnerabilities, including gaps in knowledge or exposure to unforeseen market shifts. As a consequence, investors might neglect the importance of ongoing learning and risk management. This complacency can ultimately make them more susceptible to losses, especially during periods of market volatility. Recognizing these pitfalls is essential for maintaining a balanced and resilient investment approach. To understand Warren Buffett's metaphor, it's important to look beyond the surface. In his famous saying, "Only when the tide goes out do you discover who's been swimming naked." The tide represents favorable market conditions or economic prosperity. When times are good, weaknesses in companies or investors are often hidden. Swimming naked refers to those who have taken excessive risks or failed to prepare for downturns. When the market shifts and the tide goes out, these vulnerabilities become exposed. Buffett's metaphor highlights the importance of sound fundamentals and caution, especially when conditions seem favorable. In financial markets, the tide often refers to the overall level of liquidity available. This includes factors like easy access to money, low interest rates, and an abundance of capital flowing through the system. When liquidity is high, investments tend to perform well across the board, making it appear as though everyone is making smart decisions. In such environments, even risky ventures may succeed simply because there is so much money chasing opportunities. The phrase, "a rising tide lifts all boats," captures this phenomenon, suggesting that favorable conditions benefit nearly everyone, regardless of individual skill or strategy. However, it's important to recognize that these circumstances can mask underlying risks and weaknesses. When we talk about the tide going out, it's important to understand that this phrase does not refer to the crash itself. Instead, it describes the withdrawal of liquidity from the market. As liquidity recedes, previously hidden vulnerabilities and weaknesses become exposed. This process often reveals which assets, companies, or strategies were overly reliant on easy money. The actual crash may follow, but the initial danger lies in the exposure created by the absence of liquidity. Recognizing this distinction helps us better understand the dynamics at play during periods of financial stress. Traditionally, the phrase "swimming naked" has been used to describe individuals or organizations exposed when market conditions change, often referring to those engaged in fraudulent activities. However, this definition can be broadened to encompass anyone, be it a person, company, or strategy, that relies heavily on abundant liquidity. When liquidity dries up, these entities may find themselves vulnerable, regardless of whether their actions were dishonest or simply risky. The exposure is not limited to clear-cut cases of fraud. It can also affect those whose business models or investment approaches depend on easy access to capital. This expanded perspective highlights the importance of understanding underlying dependencies in financial markets. Ultimately, it serves as a reminder that risk can exist even in seemingly stable environments, and that true resilience is tested when conditions become less favorable. Swimming naked is a metaphor often used to describe situations where individuals or companies expose themselves to significant risk, especially when times are good and underlying vulnerabilities are hidden. At the corporate level, this can manifest as taking on excessive debt, operating with minimal cash reserves, or relying heavily on margin loans to finance growth. For example, a company might expand aggressively without maintaining enough liquidity, leaving it vulnerable if market conditions suddenly change. On a personal level, swimming naked might involve investing in speculative assets without proper diversification or borrowing heavily to fund investments. When the tide turns, such as during an economic downturn, these risks become apparent, often leading to financial distress. Both corporations and individuals can find themselves exposed if they neglect prudent financial safeguards. When we turn the metaphor inward, it becomes clear that individual investors are often exposed by their own risky behaviors and assumptions. Overconfidence, a tendency to chase trends, or ignoring the fundamentals can leave one vulnerable when market conditions shift unexpectedly. Just as a swimmer who ventures too far from shore without considering the tides investors may find themselves unprepared for sudden downturns. Relying on past successes or popular advice can foster a false sense of security. Recognizing these patterns is essential for developing a more resilient investment approach. By understanding and addressing personal risk factors, investors can better protect themselves from unfavorable outcomes. As we revisit the investigation, it's important to distinguish between the passive myth and the active personal warning highlighted by Warren Buffett's quote. The passive myth suggests that outcomes are predetermined and that individuals have little influence over their own fate. In contrast, Buffett's words serve as a reminder that personal responsibility and vigilance are crucial. By actively engaging with information and making informed decisions, we can avoid common pitfalls. This contrast closes the loop on our inquiry, emphasizing that awareness and action are key to navigating uncertainty. Ultimately, the lesson is clear. Relying on passive beliefs can be risky, while taking personal initiative offers a path to greater security and success. Here comes the pivotal realization. The quote we've been examining isn't just a window into someone else's experience. It's a mirror reflecting our own investment habits. The true risk isn't out there in the market or in the words of others. It's in our own tendency to become complacent with our portfolios. When we stop questioning our choices and assume our strategies are foolproof, we expose ourselves to unseen vulnerabilities. This moment of clarity challenges us to look inward, reevaluate our assumptions, and recognize that self-reflection is essential for long-term financial resilience. Investors often find themselves fixated on the missteps and failures of others, using these examples as cautionary tales. However, this focus can inadvertently lead them to overlook their own vulnerabilities. When market conditions are favorable and returns are strong, it's easy to assume that risks are minimal or even irrelevant. This sense of security can cause investors to ignore warning signs within their own portfolios. By concentrating on external failures, they may neglect to assess how exposed they are to potential downturns. Recognizing this tendency is crucial for maintaining a balanced perspective and making informed decisions, regardless of the prevailing market climate. In today's fast-paced world, it's easy to fall into the trap of complacency, believing that simply maintaining the status quo is enough. This mindset can prevent us from recognizing areas where growth is needed. Rather than relying on external judgments or comparisons, true progress begins with honest self-inspection. By regularly evaluating our own actions and motivations, we can identify opportunities for improvement that might otherwise go unnoticed. Focusing inward allows us to set meaningful goals and avoid stagnation, ensuring that we continue to evolve both personally and professionally. A prudent investor understands the importance of preparing for times when liquidity may be withdrawn from the market. By focusing on safety, they build portfolios that can withstand unexpected shocks and downturns. This approach fosters peace of mind, knowing that their investments are resilient even in turbulent conditions. Ease comes from having a clear strategy, with assets allocated in a way that balances growth and protection. Ultimately, anticipating and planning for the inevitable challenges ensures long-term financial stability and confidence in the face of uncertainty. A fortress balance sheet refers to a financial position that is exceptionally strong and resilient, capable of withstanding economic shocks and unexpected challenges. This concept emphasizes the importance of having ample liquidity, low levels of debt, and diversified assets. Maintaining a margin of safety means ensuring there is a buffer between your resources and potential risks, whether in personal or corporate finances. For individuals, this could involve keeping emergency savings and avoiding excessive borrowing. For companies, it often means prudent cash management and conservative leverage. By prioritizing a fortress balance sheet and a margin of safety, both individuals and organizations can navigate uncertainty with greater confidence and stability. Peace of mind is a powerful benefit of thorough financial preparation. When you have a solid plan in place, market downturns become less intimidating, allowing you to remain calm and focused even during periods of uncertainty. Instead of reacting with anxiety or panic, you can trust in the strategies and safeguards you've established. This sense of security enables you to make rational decisions rather than emotional ones and maintain confidence in your long-term goals. Ultimately, being well prepared means that short-term market fluctuations do not disrupt your overall financial well-being. True financial ease is not simply a matter of luck or timing. It is the result of thorough and deliberate preparation. By building a strong financial foundation, investors equip themselves to withstand market volatility and uncertainty. When sudden downturns cause widespread panic and force many to sell their assets hastily, those who have prepared can remain calm and act with confidence. Robust preparation includes maintaining adequate reserves, diversifying investments, and understanding market cycles. This approach allows investors to make rational decisions, even when others are driven by fear. Ultimately, financial ease is achieved by anticipating challenges and being ready to seize opportunities when they arise. Warren Buffett's famous quote reminds us that financial storms reveal who is truly prepared. Instead of comparing ourselves to others or passing judgment, the real lesson is to concentrate on building our own financial resilience. By maintaining healthy savings, managing risks, and planning for uncertainty, we can avoid being caught off guard when challenges arise. The goal is to ensure that, when the tide goes out, we are not left exposed. Ultimately, Buffett encourages us to prioritize our own stability, so we are never the naked swimmer in difficult times. We value your insights and experiences when it comes to managing financial risk. If you have personal strategies for avoiding financial exposure, we encourage you to share them with us. Your approaches could help others navigate the complexities of investing more confidently. Additionally, if there are any investing quotes you find thought-provoking or would like to see analyzed in the future, please let us know. Your suggestions help shape our content and ensure it remains relevant to your interests. Together, we can foster a community of informed and thoughtful investors.